Unlike lessees, lessors continue with a dual model: finance lease and operating lease. In this video, we will cover both models and how to account for them. First, let's discuss what a finance lease is. A lease is classified as a finance lease if it transfers substantially all risks and rewards of ownership. To determine if this is the case, we can look at 5 indicators. The first 3 relate to the lease term and the residual value. The fourth relates to whether the lessee has the option to purchase the asset at a bargain price. And the fifth considers other facts and circumstances. So let's go through these one by one. For finance leases, IFRS 16 says that either of the following conditions must be met for the lease to be classified as a finance lease. The first condition relates to the lease term. The lease term should not be for the major part of the remaining economic life of the asset. For example, if an asset has a useful life of 10 years and the lease term is 9 years, then this condition is met. But if the useful life is 10 years and the lease term is only 2 years, then this condition is not met. Condition 2 deals with the present value of the lease payments. The present value of the minimum lease payments must equal or exceed substantially all of the fair value of the asset. The present value of lease payments is calculated by discounting all future lease payments using the lessee's incremental borrowing rate. If this amount is equal or greater than the fair value of the asset, then this condition is met. Otherwise, it's not. And the third condition deals with the residual value. At the end of the lease term, the fair value of the residual value should equal or exceed substantially all of the asset's fair value. If any of these 3 conditions are met, the lease is classified as a finance lease. The next 2 conditions relate to the bargain purchase option. IFRS 16 says that if the lease contains an option to purchase the asset at a bargain purchase price at the end of the lease term, then this may indicate that the lease is a finance lease. Whether the option is actually exercised is not relevant. It only matters whether the option exists. If the option price is less than the fair value of the asset, then this condition is considered to be met. Otherwise, it's not. And finally, there's a catch-all condition. Other facts and circumstances may indicate that a lease is a finance lease, even if the above conditions aren't met. For example, if the lease payments are so low that it's clear that the lessor is providing a significant financing component, then this would suggest that the lease is a finance lease. Let's see an example to illustrate how to classify a lease. A company owns machinery that costs $100,000 and has a useful life of 5 years. The company leases out this machinery to another entity for 5 years. The lease payments are $25,000 per year, and the risk and rewards of ownership have been substantially transferred. In this case, all 3 conditions are met. The lease term is for the major part of the asset's useful life. The present value of the lease payments is higher than the fair value of the asset, and the residual value is 0. Therefore, this is a finance lease. Now let's talk about the accounting treatment for finance leases. When a finance lease is entered into, the lessor needs to do 3 things. The first thing is to recognize the asset. This means removing the asset and any related accumulated depreciation from the balance sheet. This is because the risks and rewards of ownership have been transferred to the lessee. The second thing is to recognize a lease receivable. This is a financial asset representing the present value of the lease payments. It's initially recorded at the fair value of the asset. And the third thing is to recognize finance income. This represents the interest income that the lessor earns on the lease receivable. It's recognized over the lease term at the rate implicit in the lease payments. Now, let's see an example. The company that we talked about earlier leased out the machinery for 5 years with no residual value. The lease payments are $25,000 per year, and the interest rate used to discount these payments is 5%. Here's how the journal entries would look like. At the beginning of the lease, the company would debit the lease receivable for the present value of the lease payments and credit the machinery account. The machinery account has a credit balance, which represents the accumulated depreciation. So the balance in the machinery account would be reduced by the accumulated depreciation, and then closed out with a journal entry. At the end of the lease term, the company would recognize interest income. Here's the journal entry. Interest expense is debited and finance income is credited. Now let's move on to the second type of lease, the operating lease. An operating lease is when a lease does not transfer substantially all the risks and rewards of ownership. This is pretty much the opposite of a finance lease. Since operating leases don't involve transferring ownership, they're accounted for very similarly to how sales of assets are accounted for. Let's look at an example. A building has a fair value of $1 million and a useful life of 40 years. The company decides to lease out the building for 2 years. The lease payments are $100,000 per year, and the risks and rewards of ownership have not been transferred. In this case, the lease is an operating lease. To account for an operating lease, the company needs to make 2 journal entries. The first is to record the lease income. This is recognized evenly over the lease term since the lease payments are received evenly. The second journal entry is to record the depreciation expense on the building. This is recognized over the useful life of the building. Here's the journal entry for the lease income. Note that we debit accounts receivable for $100,000 since the lease payments are received in advance. At the end of the year, we'll recognize the rental income by debiting an expense account and crediting accounts receivable. And here's the journal entry for depreciation. The building is depreciated using the straight line method. So let's summarize the key differences between finance and operating leases. With a finance lease, the risks and rewards of ownership are transferred to the lessee. So the lessor removes the asset from their balance sheet and recognizes a lease receivable and finance income. With an operating lease, the risks and rewards of ownership are not transferred to the lessee. So the lessor continues to recognize the asset and depreciate it as if they were still the ones using it. Instead, they recognize lease income from the lease payments,